Payday just hit your account. For a few hours, the balance looks bigger than it's looked all month. Then the rent comes out, the car payment, the credit card minimum, the subscription you forgot you still had. By the time everything clears, you're right back to almost nothing, days away from broke, waiting for the next payday to do it all over again. Here's the part that doesn't add up. You make more money than you did 5 years ago, so why does it still feel like you're one bad week away from disaster? That feeling has an actual name, and it isn't really a story about being bad with money. It's called living paycheck to paycheck, and it reaches far deeper into the income scale than most people assume, including plenty of households earning what anyone would call a good salary. So let's look at the real economics behind it, why more income alone doesn't fix it, where the money is actually going each month, and what it genuinely takes to build even a small amount of breathing room. The common assumption is that this only happens to people who don't earn enough. The economics tell a different story. Plenty of households well above the median income report running out of money before the next payday arrives because the gap between income and expenses isn't fixed, it moves with the household. Surveys on this topic consistently find a striking share of even six-figure households reporting the exact same month-to-month squeeze as households earning far less. Earn more, and in most cases, spending quietly rises to match it, long before anyone consciously decides to let that happen. That's the mechanism economists call lifestyle inflation, and it's less about greed than about how naturally comfort expands to fill available income. A raise turns into a slightly bigger apartment, a newer car, a few more dinners out, small upgrades that each feel completely reasonable on their own. None of them look like the problem individually. Together, they silently rebuild the exact same gap that existed at a lower income, just with more expensive furniture around it. Underneath the psychology, there's a harder, more structural problem. In a lot of markets, the biggest fixed costs, housing, healthcare, childcare, and insurance, have climbed faster over the years than typical wages have, meaning a larger slice of every paycheck disappears before a single discretionary dollar gets spent. Two people earning the exact same salary a decade apart can end up with very different amounts of breathing room simply because of what their paycheck now has to cover before anything else. This isn't a story about people making worse choices than a generation ago. It's a story about the starting line moving further back so the same income buys noticeably less breathing room than it once did. Debt adds its own steady drain on top of that. Credit cards, buy now, pay later installments, auto loans, and student loans all come with a recurring minimum payment that has to be made every single cycle, regardless of what else is happening that month. Even when the original purchase is long forgotten, the payment keeps showing up, steadily narrowing the gap every single cycle. None of these payments build anything or grow in value. They simply have to be fed on schedule before anything else gets decided with what's left. Then there's a quieter trap, budgeting off the wrong number entirely. The salary printed on an offer letter isn't the number that actually lands in an account. Taxes, insurance premiums, and retirement contributions all come out first, sometimes shrinking that headline figure by a fifth or more before it ever reaches a wallet. It's not dishonesty, it's simply planning around a number that was never actually available to spend. Plenty of household budgets get built around the bigger, gross number, which guarantees a shortfall before the month has even started. Let's run the numbers. Picture a household bringing in $75,000 a year, a solid, comfortable-sounding income by most measures. After taxes, take-home pay might land closer to $58,000. Housing alone, rent or a mortgage, often claims somewhere around 30% of that, roughly $17,000 a year. Insurance, utilities, and transportation might take another $12,000. Groceries and everyday essentials add $10,000 more. A car payment and minimum debt payments could easily add another $8,000. Add it up, and you're already past $47,000 before a single discretionary purchase, vacation, or unplanned expense enters the picture, leaving a genuinely thin margin on an income most people would assume was more than comfortable. A few patterns make the gap worse without anyone noticing in real time. Windfalls, a bonus, a tax refund, a bit of overtime, frequently get treated as free money rather than a chance to actually close the gap. Every raise quietly funds a lifestyle upgrade before it funds any actual cushion. Some also chase a slightly better job or a raise as the only solution, without ever changing what happens to the extra money once it arrives, which quietly recreates the exact same gap at a new, higher number. Minimum payments on debt get treated as the whole plan instead of the bare minimum they actually are, and very few households can say with any real confidence exactly where last month's money went, which makes the gap almost impossible to close on purpose. This is exactly why the situation is so fragile. With no real buffer between income and expenses, a single unplanned cost, a car repair, a medical bill, a slow month of hours, doesn't just create a rough week, it can push a household straight onto a credit card, and from there, straight into the same debt servicing cycle that was already eating the budget in the first place. The dollar amount of the emergency rarely matters as much as whether there was ever a buffer built to absorb it in the first place. The paycheck-to-paycheck cycle rarely breaks from a big dramatic mistake. It usually breaks from one ordinary bad week landing with nothing underneath it. Breaking it rarely starts with earning more, since more income on its own tends to just move the same gap to a higher number. It starts with building even a small buffer before anything else, enough to absorb one bad month without reaching for a credit card. It means treating the biggest fixed costs, housing, insurance, debt interest rates, as the real target for negotiation, since trimming small daily purchases barely moves a budget that's already strained by rent and payments. None of this requires a dramatic overhaul overnight. A genuinely small, automatic transfer the day a paycheck lands, treated as non-negotiable as rent, tends to outperform any amount of willpower applied after the money has already reached a checking account. And it means deciding in advance that at least part of every raise goes toward that gap before lifestyle catches up to the new number. The broader picture has shifted too. In many regions, housing and childcare costs have outpaced overall wage growth for years running. Healthcare costs and insurance premiums have followed a similar pattern in plenty of markets, rising well ahead of typical raises. Buy now, pay later services have made it as easy than ever to spread a purchase across several invisible future paychecks, often without it ever showing up as debt in anyone's mental math. And a growing share of workers now deal with genuinely variable income, gig work, tips, and irregular hours, which makes a steady, predictable budget even harder to build in the first place. None of this means income doesn't matter or that personal choices don't matter either. Both genuinely shape the outcome. A household with rising fixed costs and stagnant wages faces a harder version of this problem than one without. A household that lets every raise fund a bigger lifestyle faces a version of it that's largely self-inflicted. Most real situations sit somewhere between the two, shaped by both forces at once, not neatly explained by either one alone. So, is living paycheck to paycheck really just about how much someone earns? Not entirely. It's really about the size of the gap between income and expenses, and whether that gap is ever allowed to exist long enough to matter. Rising costs make that gap harder to open. Lifestyle inflation quietly closes it back up even when income rises. Either force alone can trap a household at almost any salary, which is exactly why raises so rarely feel like they solve the problem on their own. In the end, nobody escapes this cycle by earning their way past it. They escape it by protecting a gap, however small, and refusing to let the next raise fill it back in.